People are still filing in the room here. Anyway, thank you for coming. Show of hands, who is here for the first time? Wow, that's a pretty decent number. Who's here for this? Peace to you too, brother. Oh, okay. Who's here for the second time? That means you liked us well enough to come back. And I'm going to stop right there. So I am going to introduce a gentleman who I have known for, I don't know, how long have we known each other now?
10 years?
No, not quite. You wish, but it hasn't been 10 years. Either way, he lives out of town. However, I speak to him frequently, and I have utmost respect for him. But the reason that I'm going to introduce him is because his name is Jeff Young, by the way, just in case you were wondering. Stand up, Jeff, just so they can see your beautiful face. There you go. Jeff is joining our team on the Investor Relations department, and Jeff will tell you a little bit about his background. But I'm happy to have him here, and happy to have him on staff. We look for great things from him, but more importantly, what I think is going to be is great things for you, our partners, because we will be able to cover more of you in terms of your needs, your questions, as it relates to anything DGRE or your investments with us. We've been growing by leaps and bounds, and I've got to tell you, I'm getting old. I can't handle that many calls a day, neither can Garrett, so we needed a third person. And he's younger and better looking, so take it away, Jeff.
Hello, everyone. Here's our agenda for the night. Notice my name's not on there, so I don't have to talk very long. So it's just oh, there it is. So this just tells a little bit about me, but I was going to tell you about me anyway. So it says right here, while still wearing scrubs and lab coats, became an investor. So my background has been in the medical field, not a physician, not a anesthesiologist, not anything high level as a medical technician. So I've always had kind of a 5-figure income and was never really getting ahead. I was very passionate about my work, loved what I did, but I was able to live within my means and start investing about 10 years ago. Everyone in this room probably knows what an accredited investor is. I am now an accredited investor, and that's hard to believe considering the type of work I was doing. But by putting a little bit aside and getting to the point where I could start investing, I've been able to grow that nest egg to the point where I am now accredited. I've got a 7-figure net worth, and I am excited to share my knowledge with everyone and anyone in this room and online to tell them about how this has worked in my life and how we can partner to bring you on board to use our experience and get you to the same place. Whoa. Okay, now we're echoing. So that's a little bit about me. Darwin brought me on about 2 months ago. But again, I've got years of experience as an investor and watching and learning from the best. So, what I did in the medical field, if you weren't here 18 months ago when I came in my lab coat, is I worked for an eye bank. So I actually recovered eyes from people that had passed away, and the corneas were used for transplant. So an easy transition for me, according to Darwin, is that I was making cold calls to families that had just lost loved ones. So I was calling to educate them and explain to them the value and the benefit of being a donor and letting your loved one help others through donation. So after doing that, it really showed like being able to educate someone really quickly on the phone and showing compassion and kind of partnering with them to get through the process. That's hopefully what I'll bring to the DGRE team with bringing on new investors or addressing questions from investors that have been with us a long time that may or may not feel comfortable with certain deals. We're good?
Good.
Oh.
So what I want to say, first of all, thank you for that service, because I've never had to endure that either personally or a family member that would need an organ. So a valuable service that you provide for people. But I always approach things from what's the benefit, right? There are features and then there are benefits in life. And so I talked about one of the benefits being that we'll be able to cover more of your needs and your questions. But even more importantly, and maybe something that wouldn't be so apparent, is that with Jeff's background and his willingness and ability to talk with new people who are constantly reaching out to us, the more investors, the more partners that we gain, the greater our reach, and the greater our reach, the more opportunities that we'll have for you. And the more opportunities we have for you, the more accredited investors we generate, as we did with you. So thank you for your service there and for your service to come. And so I think I should introduce another friend of the family here. He's not as good looking as Jeff, but
I have more hair.
But he has. Oh, that's cool. So without further introduction, this is our founder, Darwin.
I don't need that.
Oh, you're mic'd up already.
I'm mic'd up, yeah. Supposedly. I don't know if it's on or not, but we'll see. All right. Like I said, Jeff, I wanted him to tell his whole story, but I guess
I'll tell the story in person or on the phone when I talk to every one of you.
Okay, good. All right, real quick. We realized we never put a calendar of events up before as far as what we can expect on what we're doing. So we've got a couple of fun things. First off, for those of you in Iron Ranch, we're having a groundbreaking with the city coming out there on May 23rd at 1:30. Everybody's invited to come out to that. That's in Fate, Texas. May 16th, we actually are kicking off the Young Guns program. I don't know if you remember that. Do you have a microphone? So the Young Guns program is kicking off, and we'll have a Zoom call on that, and that'll be next Wednesday at 4, so every 2 weeks we'll be having that, and just to help young people. It's like focused from 16 to 28 years old. Here, just wait, here, sit down for a second. And then June 12th, for a meeting there, a guy named Adam Coffey. You've heard me talk about him. This is a guy that builds businesses, billion-dollar businesses. He's had over $3 billion exits as far as building up businesses, and that's who I've been getting some coaching from recently. And so he's going to come talk, and he is dynamic. And just to give you an idea, I think he turned down a huge. I don't know if I'm allowed to say it, but here's the whole thing. It's about 4 times my net worth for him to go to work for this private equity company I'm building up some more. And he said, no, I'm done. You know what? I just want to have fun. So he's helping us on deals as well as a bunch of other people. July 22nd, we are having a event at the Ranger Stadium. Does anybody like baseball? Okay. Does anybody like the Rangers? Does anybody like the Dodgers? Nobody. That's what I grew up, is watching Dodgers. But we did an event like that for our entire company last Wednesday. We let everybody off, went over for a noon game, and did that, and created and put together some little swag bags that got put together. So, who are baseball fans in here?
My son.
There, your son. There you go. You raise your hand. There you go. Okay, and third. Just a little goodie bag. Nothing major, but that was something we put together for our team, and they all came out, had a great time, and it's all about building additional camaraderie and a great corporate environment for everybody. Updates. Iron Ranch. If you've driven out there, you saw our sign on the property. So that one's going great. We are now in a position that we're getting loan approval this month. And May 23rd, we've got our groundbreaking. June 1st, they're going to start moving dirt, start getting everything prepped. July 1st, we're anticipating going vertical. And construction's 8 to 12 months. We're already about 40% pre-leased. So it's going great. Everything's good. To give you an idea, we had a little problem. Our budget was about $20 million, and our first bids came in at about $24 million. So we had to do a lot of value engineering to get that price down. But it is now right at actually under the $20 million mark. Okay? The mark.
I'm sorry, I was out of the room. Did you discuss the sort of development that's on the corner?
No.
And the reason being is because they've just broken ground on phase 2 of that development, adding another 29,000 feet of restaurant and retail space.
Okay. So I don't know if you heard that or not, but they built a Freshens and a big Fresh?
Just called Fresh.
It's called Fresh, not Freshens.
I didn't name it, don't ask me.
Okay, they have a big grocery store anchored development there. They're adding phase 2, and that's literally, quarter mile down the street, and quarter mile before that, they should be going on this huge center that's going on there. So our location's great. And we're already scoping out, by the way, I didn't put it on there, another 2 to 3 locations that we're going to get started on sometime soon. We had a meeting with Waco and Melissa, and trying to find something. I actually went and met with Hillwood for up in Argyle, but that's not going to go. The Mark. I'm going to give you an update on that. This deal has had a lot of brain damage going along with it. Okay, I'm going to tell you all what's happening, okay? And it's all the work that us and our team are going through. And I don't want to scare anybody off with this. We always have challenges going through deals, and this one has some unique challenges that we haven't had before. And that's because when we put it under contract, it was a regular deal. We were looking at a 17% plus return on that deal as a market rate deal. And then we learned about PFCs, Public Facilities Corporations, where basically you do a joint venture with them and you don't pay any property tax, and not paying property tax adds about $20 million in value to the property. Great, great deal. We started working with our consultant through there, and it has to go. The PFC is the housing department for Weatherford, and they're the ones who are doing the deal with us as the buyers. It went to City Council to get approved, and City Council said, wait a minute, we didn't know anything about this. So they tabled it. Our consultant, who was working technically for the city, for Weatherford Housing, he basically said, this is too political. I don't want to deal with Weatherford, I quit. And the problem is, when you do the PFC, you lose all your tax revenue. So the schools hate it, the hospital, the county, all the municipalities all hate it. So we switched over to another company called Texas Essentials. And they're in a small district outside of Austin. And their housing department has been doing a bunch of these, hundreds of these, all over Texas. PFCs. They've been doing PFCs all over Texas. Now, as a city, imagine you're a mayor, council member, anything like that, and all of a sudden you find out that somebody bought that property and it's now a PFC and there's no property tax revenue coming in there. Would you be happy about that? City doesn't have any control over that. So we were working with them. We're working with them on another project that they're going through and getting approved. And there are bills in the Texas Congress right now that Monday, or Tuesday, or today's Tuesday, yesterday, they voted to completely dissolve that company, Texas Essentials. They voted basically to put them out of business, to close that loophole. So that took us, we lost Weatherford, then we lost that Texas Essentials. And so there were so many variables because we need to know how we're going to buy it, how we're going to finance it, how our equity is going, and all of these variables that had, and the seller. The seller was a variable also because we've had this under contract since December. And so they've given us time and time and time and time and time. So we have nothing solidified. At the very beginning we did. And then as you go through a transaction, and things like this happen in every transaction, there's always something. But this one having government agencies that can squash whatever you're doing, getting approvals from cities, hurry up and wait, they only meet once a month, yada, 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 yada. All the other crap we're dealing with. So yesterday, after phone calls to all of our representatives of Texas and tracking down the authors of these bills and talking to them, is it going to go, is it not going to go? I talked to all of them and finally said, okay, it's set, reading the tea leaves, this is going to die. We're not going to be able to do a PFC. So I was perfectly fine with that. So hit reset, call the lender, call the seller, call our equity company, New York Mortgage Trust, call all these things, get it back going in that direction. And I'll be damned. Get a call that Weatherford's looking at it again. Weatherford Housing's looking at it again. So I'm like, okay, so all these things have just been very, very difficult. So bottom line is it's still moving ahead. We're still going to try and do the PFC. If we don't do the PFC, it's going to be a regular market deal. And we'll have to do a supplemental that'll have to be signed, okay? So, but you can always pull out if you want on the supplemental, but it's still a great deal. So that's where we are on the mark. And it has been brain damage.
I love to interrupt.
I know.
Going back to Iron Ranch, I get periodic questions about the pref. Okay?
Yes.
And so for the benefit of the group and those online, would you quickly explain not only what a pref is, but in particular what the pref on this particular deal is?
Okay. For those of you who don't know what a pref is, it's a preferred return. And a lot of times in syndications like we do, the sponsor would give the investors a fixed rate of return as a preferred return. It gets paid first. Might be a 6% pref, 8, 10, 12, whatever it is. It's a preferred return that would go to you guys as investors before there's any split back to the sponsors. And usually when they do that, it'll be like, because we do a standard 80-20, we're even in the whole deal. If we were to do a pref, it'd be like, okay, we do an 8% preferred return, meaning you're going to make 8% on your money before there's any split, but then it's a 70-30 split. So the numbers work out pretty similar. The pref, if the deal is great, because we would have a higher ownership percentage, if the returns were higher, you would get a lower return. So with how high our yields have been, it's been better for you not to have the pref, even though it comes across as, hey, I know I'm going to make this amount minimum, and that's not guaranteed, obviously, but it's a preferred return. It comes out first. On Iron Ranch, we did an absolutely stupid deal, and we offered a 25% pref, okay? Unheard of. Absolutely stupid on our side. So that means that as investors in Iron Ranch, you get 25% per year coming back to you before the sponsors make anything. You follow that? 25% return to you each year before we make anything. It's stupid, ridiculous high. Okay, so that's the way that it's designed though, but because there was so much value in it, we could do that. And getting this first one up off the ground, we decided to go that route. So, never do that again. Never, it will never, ever, ever happen again. It is an absolutely asinine amount of preferred return that you would never get, okay? Who's in on Iron Ranch, by the way? Yep, you guys are gonna kill it. It's a 25% pref and then a 50-50 split, okay? And the projected returns are well over 30% for the partners, and we're anticipating a year 3 cash out refinance of 175% in year 3. And then you still have your ownership. Stupid. Absolutely stupid. Okay. And we are growing. Did Mike come? No. Okay. We had a directive, well, let me rephrase. I told the team, here's what I want to do. I want to bring on third-party management. I want to grow the management company side of it. And before Brian retired, he was going to be in charge of, of that growth. Well, I think there's something cosmic or God involved, or however you want to do that, however you believe in that, you say it and it goes out in the universe and it helps you accomplish it. So we said we want to take on third-party management. It was less than 3 weeks later, we get an email asking us to bid on a property in DeSoto that the property management company is screwing up on. And so I call the guy and I say, how'd you get our name? I mean, we don't advertise, we don't do anything for third-party management. He basically had his assistant send an email to all of the companies in that area, all the property management companies around his property. We met with him and hit it off really well, okay? And hit it off so much, he does something similar. He was in town to switch management companies and to do a presentation because he does something similar to this. He trains people how to develop apartments. And then he goes in with you and helps put the money together to go ahead and build apartments. So that's what his main thing is. So they're all brand new properties except for one. And he was calling us on that one, along with other people, because the management company was screwing it up. It was only 58% occupied, something ridiculous. And we met with him. Well, actually I didn't. Vicki and Julian did. And that took it to the next step, and they were going to meet the next day. So I went out and met with him. And he said, I like what you guys do. I like that you're owners and you understand what it is from an owner's point of view, which most third-party management companies don't. So we're growing the third-party management side, and they chose us to go ahead and take over those properties. They had Vicki jump through freaking hoops on doing budgets for all the property. No promises. Doing budgets for all the properties, doing everything else. They were testing us. But he did invite us to come to his meeting and speak at his meeting, so we thought, oh, this is a good chance. But then he had jump through hoop. Then last Monday, he calls and says, I'm ready. Take over management tomorrow. Of course, we told him, he said, how much time do you need? We said a week. We can do it in a week. And everybody in the room, when he was interviewing us in front, oh, you can do that in a week? Wow. We can make anything happen. And so we took over that property management. These are newer properties. Here's an idea. So they're all brand new. They're all new properties. You can see, I mean, that's kind of what they build, is that same type of thing. It'll end up being about 1,200 units. But right now it's only 4 properties. They're building another one in Gainesville that we'll take over also. And we've already been on site, already doing leasing. And the management company, oh, get this. The management company that was there was supposed to, we were taking over on the 2nd. They were supposed to stay until the 8th to help that transition. We showed up on Tuesday. They shredded all the documents, wiped the computers clean. Other properties, they took everything, including janitorial mops and brooms, and okay, this was, and walked out with all the trash bags. We couldn't go through anything. Who knows what was in that? It's ridiculous. So that's the type of thing you deal with third-party management. So we took those over. New offices. We're building out new offices right here in the lobby area. Yeah. What's another benefit to working with them?
Well, I mean, for the companies it benefits, but truly for our partners, what is the benefit?
What this does, well, there's numerous benefits. Number one is it opens up, we have more management. We have more management staff. That allows us to hire more people that can service the entire management side of it, which is also part of the reason for moving investor relations over to the other office. So we have more offices for our management team, which is growing. And we have some announcements on that too. But it also then opens us up to all the properties that he has. They build to sell. So now we're in the catbird seat to be able to buy those projects. We'll know where the bodies are buried. We'll know the quality of the property. We'll have all the income and expense. We'll have all that. So we'll be able to buy those properties when they decide to sell them, should we want to. And we can also partner with them and raise money to go ahead and develop the property, make a good return on that, and then convert that over into the down payment for buying.
They're nationwide, though.
Oh yeah, they're nationwide. They're huge. So this is a really good in, and if we decided to go to other markets, maybe we could pick up something there, who knows. But we're now out to impress. And so if you know anybody that needs third-party management, that's something that we're providing now. New offices moving over there. A couple of new team members. First off, Pam, stand up. Okay, Pam, you in here? She's over here. Pam is one of our new regional supervisors. Okay, Jay Lee, stand up. Another one of our new property supervisors, and they were both promoted from within. That's something that we like to do, is promote from within. They understand our systems, they understand the team, and quite honestly, for the other staff that's out there, they say, good, you're not going to bring in somebody from the outside that's going to jump ahead of me. And usually that hurts corporate culture. So those are some of the new people, and obviously Jeff Young, who you just met. So that's part of the growth we're having now. Young guns. Okay, now Garrett. Pretty funny picture. And so Garrett is heading this up. And so tell us a little about what it is, what we're going to do, when we're going to do it, et cetera.
Kind of like mentioned earlier in the slides, Darwin mentioned that the next meeting, or the kickoff meeting, will be next Wednesday at 4 o'clock. Around that time, I'll be sending out an email to everybody tomorrow in regards to everything going on with that, and we'll be doing it on a bi-weekly basis. I just finished up 2 podcasts while I was up in Steamboats with 2 great guys I met through Darwin, one a real estate agent and one an entrepreneur in landscaping. So those should be coming out relatively shortly. They'll be participating within the group, and then if you guys interested, 16 to 28, right, Darwin?
Roughly.
Will be able to participate, but anybody's welcome to attend and kind of put in their 2 cents. So.
And so we're going to go over that first meeting, what they want to get out of it, what they want to see. We'll have some investment opportunities and show them what we're doing. And there's about 8 or 9 videos on there to watch right now, which might be interesting for anybody. Okay. Management updates. I was going to have a bunch more, but some of what we're going to talk about anyway is what's going on in the market. For anybody invested in Valley Center here? Okay. That one is we've got 3 or 4 large tenants that moved out. So we've now got to backfill those tenants. One of the spaces we're going to convert over to executive suites. So the occupancy and income has dropped here on a temporary basis, meeting with our leasing agents next week might even be this week, to see what we can do to go ahead and get those spaces filled right away. Cash position is absolutely spectacular, but our income is down. Other management updates we didn't put in here right now, and Vicki does not want to come up here and talk about them because last time she was not feeling well afterward. Crowdfunding. This is interesting, okay? Anybody know what anybody don't know what crowdfunding is? Okay. Crowdfunding is, we do Reg D 506 B's and C's. That's the IRS regulations that allow us to go ahead and do syndications. There's a Reg CF, crowdfunding. And you have to be a broker-dealer to go ahead and do it. You have to, there's certain restrictions, but unaccredited can invest through there. And you can also invest as little as $100, okay? And in a crowdfunding thing. You've seen crowdfunding all over the place. They do it a lot for startup businesses, things like that. So I had players that were saying, by the way, you're not showing that on the screen, right, Mo? Well, you'll erase it. This is the reason why. We're not allowed to show uniforms per NFL. So this is just a sample just to show you up here. So these athletes that we had meetings with, they want to invest, but they also want to get paid for, like any influencer, they want to make money on what they can bring in and what they can do. So the challenge is, how can we do this? And I got hooked up with a broker-dealer, and we are setting up crowdfunding pages. And the way that this works is, let's just say Joey. Joey's probably listening in right now. We set up in our own platform a crowdfunding with Joey, for example. He goes out, sends out to his social media, his friends, his family, whatever it is, and he points them to his page. You click on that and his opens up. They can invest there into his LLC. That LLC then that invests in, for example, the mark. But he gets then the override. See, we could do this with professional athletes. We can do the, NFL, NBA, professional golfers, who knows, whatever it might be.
Can we get Kim Kardashian, people like that?
And that's the next step, is we can have influencers, or we can have you. Right there, I'm thinking about you first, okay? The limitation is they can only raise $5 million per year per offering, okay? But every one of our deals is a new offering. So if they can raise $5 million, then they participate on that part of it, and that entity then invests in whatever deal we're doing, okay? Probably can't do it in the mark because they all have to be accredited. But nonetheless, we'll be able to do that and have some options. So, for example, who in here has thought about, hey, I want to raise money and I want to get paid for it? Anybody? Okay. There hasn't been a way to do it the way that everybody wants to. Everybody wants to get paid for that. Unless you're a broker-dealer, you can't get paid. So, per the SEC. So in this instance, they're not getting paid, compensated as a payment, but they have a sponsor's ownership in their LLC that they get compensated for. Okay. Now I think it's like $20,000 per person to set up. So that way we can't just automatically give everybody one and go do it yourself. So there's a commitment level there to doing that. So that's a lot of fun. If you're interested, right now it's going through the compliance officer with the broker-dealer. Right? Right, Reggie? Okay. Compliance officers, you're used to that, right? Yep. Okay. So that's kind of a fun program that we'll be able to go ahead and do to help raise money. This is all part of our growth and our ability to attract more capital and get in with a lot of people with a lot of reach. Okay? So you can do that as well. Again, like I said, it's about a $20,000 setup to go ahead and put you on there. Again, it's not approved yet. We're developing the back office side of it, and we have to get approved by the SEC. Okay? So, that's all of our updates and information that we have right now. So we have got a very special guest, the godfather of real estate in DFW, the guy that probably does half of the apartment loans in DFW. Welcome up, Paul Peebles.
Can you hear me?
Thanks, sir.
Hello, hello, hello. Hello to everybody.
Hello.
I'm hoping everybody can hear me. All right. Nikolai, how are you? So I'm Paul Peebles. I'm with Old Capital. So we are a multifamily lender, and we do about $1.6 billion a year in apartment loans.
You slacker, that's it?
That's about it. So tonight I'm going to tell you some stories. So I'm going to kind of bring you up to date. You may fall asleep in the middle of the story, and I give you permission to walk out. But tonight I'm going to tell you a little bit about my interpretation of some stories. And where is Garrett? Is he around? Darwin, can you grab Garrett real quick here? Garrett, come over here, please. Now, he doesn't know I'm doing this, but I want you to do this. This is kind of the impression that I get when I sat down one time to listen to my grandfather tell stories. So I'm going to do this tonight. And again, he doesn't know that I'm going to do this. But Gary, come over and sit on my knee here. And now do what I'm going to whisper in your ears. Grandpa, tell me a story.
Grandpa, can you tell me a story?
About financing in the 80s and 90s and 2000s?
About the financing in 80s, 90s, and 2000s?
Be more than happy to, son. More than happy to. Would you mind if I share that story with everybody too?
As long as I can get off your lap.
Yes. How's that? He's a good sport. Had no idea I was going to do that. So I'm hoping that this is going to come together. So I'm going to tell you a little story about my perception about what's going on yesterday, today, and hopefully tomorrow. So again, if you don't know me and what I do is that I've been in banking for 38 years. So I'm about to have a big birthday coming up here shortly, and it's going to start with a 6, unfortunately. So I'm going to tell you some stories about when I got into the business. I've been doing this for a long period of time. So a lot of people don't know some of these banking stories. And I will tell you that living in Texas here, you were in the heartbeat of the problems back in the 80s. So I'm going to talk a little bit about the 80s. I'm going to talk a little bit about the 90s. I'm going to talk a little bit about the 2000s and what's going on even today. So again, this is a dialogue and a conversation. So if you have any questions, I was right in the middle of it, all this stuff. So again, I usually wear a suit, but tonight I'm not going to. So let's kind of talk about it. And again, you can't read this, so I'm going to read this for you. All right? And I want to kind of go with that. How did we get here in 1986, prior to 1986, and talk a little bit about the Tax Reform Act. Just give you a high level on what that was all about. I did work for a savings loan at that period of time back in the early 80s, the mid 80s. So I think it's important to kind of give guys like Garrett or some folks who haven't lived in Texas or in the United States or weren't alive at that period of time to kind of give a general understanding about what went on in banking, because if we don't understand about that, we won't really understand about what's going on today. So I'm going to kind of cover it. I'm going to kind of talk a little bit about, and there's some interesting points that kind of rhymes with today of what happened back in the early 80s. And so we had huge amounts of inflation at that period of time. And if you remember, Fidelity had a money market account, and it was kind of a brand new thing. We used to have money that was in our savings accounts. And if you remember back in 1981, 82, prime rate was at what? 21%, thank you. And so huge amounts of high inflation, just like we're going through right now. And so instead of having 2%, we were up at a much larger number. Federal funds rate was at 20%, prime rate was at 21. And the philosophy really was build it and they will come. And I'll talk a little bit about that, because right here in Valley Ranch in Las Colinas was kind of the epicenter of the savings loan problem. The whole state of Texas, of Houston and Valley Ranch, Las Colinas, and Dallas was a major problem. So inflation rates and interest rates both rose dramatically in the late 1970s and early 1980s. This produced two problems for these savings and loans. And I worked for a savings and loan. First, interest rates that could pay on deposits were set by the federal government. And how many people remember how savings loans used to compete? What did we used to do to compete? Toaster ovens, that's right. And bathroom scales and all kinds of wacky stuff that we'd have to give away, because the only thing we were regulated paying was we could only pay 5%. And the rule of thumb was we could only pay 5%, and we took in loans and we charged them at 7%, and we were on the golf course by 2 p.m. So that was the kind of how the mathematics worked at that period of time. And so we couldn't pay anything more in deposits. The second thing was we made long-term fixed-rate mortgages. When interest rates rose, these mortgages lost a considerable amount of value, which essentially wiped out the S&L industry's net worth. Kind of sounds a little bit similar today with interest rates going up high. We talk about Silicon Valley Bank. We talk a little bit about some of the other savings loans / banks today that kind of bet the wrong way. So in 1982, we deregulated the savings and loans industry with the Garden-St. Germain Act, and then it made the savings loans able to compete against the banks. So now we weren't able just to pay people 5%, we were able to pay them 6, 7, 8, 9%. We were able to get into these higher rates on for these folks. So we pay higher deposit rates, and what do the lenders invest in? Well, at that period of time, if you can remember, and if you don't remember, is that a lot of savings loans got into things. Now remember Jimmy Stewart and It's a Wonderful Life. Jimmy Stewart invested in your house, and your deposits went into your house, and your deposits went into your house. So that was kind of the Wonderful Life story. Now, when they deregulated the savings and loans, we had to pay higher than 5% on the deposits. And so what we got into, and I say the royal we because I was a junior person back in 1984, 83, 84 at this period of time. I wasn't a decision maker. And I was in Southern California at that period of time before I came to Texas in 92. But at that period of time, the savings loans got into a lot of wacky investments to pay higher deposit rates. Airplane leases and construction loans, which they had never done before. They always invested in home loans. They never invested in these wacky things that people had gotten themselves in trouble with. So a lot of savings loan bankers got into things that they should never have gotten into, and that became a big problem. And so they lacked industry experience. They had rapid growth, and that fueled a lot of the thrifts paying higher and higher deposit rates. There's a book called The Daisy Chain. It was written by a newspaper man out of the Chicago Sun-Times that talked a little bit about this area. And it talked about a 737 that would leave every Monday morning from Madison Airport, fly out to San Diego, pick up depositors out of San Diego and bring them back here, bring them back to deposit their money here in Addison, Dallas, Texas. If you can remember back, and a lot of people don't remember, there's a guy named Don Dixon. Anybody remember Don Dixon at all? You ever remember a company called Vernon Savings at all? Don was a builder, a developer. He built apartment buildings. And he would come with his hat in his hand and say, hey, listen, I want to build something. The bank person was like, well, you don't have the net worth liquidity. We're not going to extend you any money. And so when they derailed the savings and loans, Don said, hey, listen, I'm going to buy a savings and loan. And so he bought a savings and loan. He moved it from Vernon, Texas, all the way to Dallas, right next to Addison Airport. And then he became his own piggy bank. So he took in deposits and he took the money out and he built everything that he wanted to build. And if you go through some of these properties up in Addison off of Keller Springs or even over off of 635 and 75, you take a look at maybe a 14-story building that has a Spanish tile roof on it. It used to be Beal Savings and Loan or Beal Bank. Then it became AT&T. That was Don Dixon built that building. The reason why I know it so well, when I came to Texas in '92 from California, I had to lease out an office. Went to that office, and it was office, residential, office, residential, office, residential. I walked into the residential piece, and I'm like, we need an office. And they said, okay, no problem. But I said, what is this Murphy bed doing here in the fireplace there? This is crazy. And so he thought it would be good for people to live and work at the same building. Maybe he was ahead of his time with COVID and things like that. It was great. It was a great idea. But all those crazy things that went on during the period of time, Don wasn't a banker. He was a developer, but he became a banker, and he was giving loans to his friends. All the craziness that went on during that period of time. And because the FSLIC insured all this stuff, it was, like I said here, flip a coin, heads the shareholders win if I make a good bet, and tails the U.S. taxpayers lose. And so they were always going to be able to be winning on these investments that they did. So in 1986, after we deregulated the savings and loans, we deregulated if you remember Ma Bell and all the phone companies that were attached to it, there was a huge amount of deregulation that went on during that period of time. American Airlines and Braniff, all these companies that were competing against each other here in the Dallas-Fort Worth area, was all a form of deregulation, so including the savings and loans. But we had a risk in the savings loans that had tied to your mom and grandma's and your aunt's deposit money. So in 1986, seeing that that they were trying to slow it down, is that we put in a new tax relief, tax piece that did not allow you to write off the interest loss on your personal income. Okay? Well, people don't, you guys, if you ever got in limited partnerships, people invested to lose money. They invested to lose money, not to make money, but to lose money. Because if you made $60,000 and you invested, say, $20,000 or so, and you weren't expecting a profit, you were expecting a loss, because you could take that maybe $10,000 loss that you had for that year and automatically deduct it off the $60,000 worth of income. And that was allowed. We wanted it to happen because we were trying to get the economy going again, because we had this huge recession back from 1980 to 1984, and we were putting people back to work at that period of time. But now they wanted to slow things down because we had already built all these apartment buildings and office buildings, and this property itself was built in 1985? 84, 85. So again, this is the remnant of the stuff. So again, post 1987, after we had this 86, apartments needed to earn a profit. We needed to earn a profit. We couldn't take losses anymore. We couldn't write off that. You couldn't write off your credit card deductions or the money you went out to lunch with anymore. You couldn't write these things off from 1986. So we had to go and make all these properties profitable, but originally they were set up to lose money. So when they stopped that, all of a sudden people were losing money, and they were like, now we got to make money. There's no way we can make any money. These are purposely trying to lose money. And so what happened is that we get a lot of savings loans and banks here in Dallas and Fort Worth and all across the United States, but especially here in Texas. We had the Texas Savings and Loan Insurance Group, then it became the FSLIC, then it became the FDIC at that period of time. And because a lot of these commercial properties failed, okay, the banks started to take these properties back. And when the banks took it back, that kind of canceled out the net worth of the bank, and then the RTC came in to capture the property. So by late 1980s, Congress decided to address the thrift industry's problems. In '89, they passed a thing called FIREA, the Financial Institution Reform Recovery Enforcement Act of 1989. Then instituted a number of reforms. The main S&L regulator, the Federal Home Loan Bank, went out. There wasn't any more money. They couldn't make these banks or savings loans liquid. They had to just take them over. And then Congress created the Office of Thrift Supervision, so that's the OTS, and then the RTC. So the OTS took in all the banks. RTC took over the properties. So if the bank went bad, RTC came in and had to be the asset manager. They had to call for the grass has got to be cut on Tuesday. The windows got to be fixed over here. The tenant comes and complains about they have a problem. The RTC had to find an asset manager, to find a property manager, to make sure everything was working at that period of time. So the RTC closed 747 savings and loans in the United States. Okay? Today, right now, for this year, I think we only have 3. But those are 3 huge banks that got shut down. And so it eventually cost us billions of dollars that the U.S. taxpayers had to come up with because we deregulated the equation for the deposits and made a lot of things that were not going through. And then it was kind of the little storm before the big storm of 2008. But how many people have ever heard of the I-30 corridor at all? Thank you. You know that very well. And how do you know that, Ms. Wolf? So there was a house painter that got going and bought himself a savings and loan out in East Dallas, in Garland and Mesquite and all these places, a guy named Danny Faulkner. And Danny went from being a house painter to being a developer. So here's my business card, I'm a developer now. And so he got into all kinds of these wacky things, and he built lots of apartments. And before he built apartments, he had to get equity. So he flipped it to you, just the land, because then he had an appraisal with his buddy who said the value now is not $10 million, but it's $12 million. I just made $2 million just by flipping the paper right there. So Danny built a bunch of equity, and then he bought a savings and loan. But in the meantime, he had built thousands and thousands of units on the way to Heath on the I-30 corridor. Anything more, Tracy, on that deal? Do you remember very much about that? Oh yeah. So Tracy and I are about this. Every time you're going out to Lake Ray Hubbard, or you're going out to Rockwall, you will go on the right-hand side and left-hand side on I-30, going past concrete pads. So it was unbelievable, and I'll show you this one thing in a second here. But Texas, where you live right now, was the epicenter. Right here was the epicenter of the thrift industry banking meltdown. So 1988, the peak of the year, the FSLIC, the Federal Savings and Loan Insurance Corporation failures, more than 40% of the thrift failures, including assisted transactions, occurred in Texas. 40% occurred right here in Dallas and Houston, Austin, and San Antonio. Then it spread to other parts of the United States, and then it was kind of a big deal. So going back to that I-30 corridor, this is a slide of somebody with a bulldozer that had to destroy a bunch of apartment buildings that were built. So, one thing that Texas likes quite a bit is that we always like to fund deals that we, our thinking always is build it and they will come. Well, nobody showed up after Danny Faulkner built all these apartment buildings. I mean, it was thousands of units built in the 1980s. And so the RTC, seeing that they had to continue to put money into these deals, they put a steel fence around these properties. And then they said, these steel fences are not working. I mean, people are breaking windows. We cannot keep the lights on these properties. We can't keep security. We are going to get some bulldozers and light these buildings on fire. And we're going to destroy them. Did you live here during that period of time?
I lived in Atlanta, and people were flooding to Atlanta because they lost their shirt in these condominiums around here.
That's right. Did you live? You lived in? Yeah, you lived. You
I
saw a
was
little.
involved with RTC, and
What'd you do for the RTC?
I was a real estate broker. Sold a lot of their stuff. Nickel on the dollar.
That's right. So
Cheap.
everything was for sale. Everything was for sale. The government did not want to hold the real estate, but nobody had cash, and the banks weren't open to fund these deals. So if cash was king. So if you were able to put a syndication or a group together, you were able to buy these properties, and you bought a ton of it, ton of the stuff. Any other stories you remember during that period of time before we move on?
I just remember trying to, I sold the deal with FDIC, and guys got cash. They want a financial statement, credit. I mean, it's like, he's got the money, just sell it to him. And it's like, no, we gotta get all this. It's just the whole bureaucracy that was just crazy getting something done.
Crazy times. Okay. All right. So now we move into 2008. Okay. I talked a little bit about 86, 80, 87, 92. Now we're moving up to 2008, and I call it really the Big Short, just like the movie, The Big Short. And so the Great Recession began in 2007 and in 2009, and it was a huge thing. Home prices fell approximately 30%, and that was just it didn't fall that much here in Texas, so to speak, but it was 41% in Southern California. So these huge swings of valuations came. People gave back their properties. They didn't feel rich anymore. They gave the properties back, and they were like, we're walking away from these deals. S&P 500 was down 57%, and it really was the rise of the subprime lending. That at right about 2005, 2006, 2007. And I call that the archangel of death, because it was called structured financials. Because if you went back prior to that period of time, it was you had to really qualify for these properties. You had to qualify. You had to show your tax returns. You had to show your income, credit, down payment, where everything had to be in place. But then there was political pressure pushed onto these lenders to make sure that everybody got a chance to have the American dream. Well, not everybody had cash, not everybody had good credit, not everybody had all this and that to get qualified. And so it wasn't the loan officers, it wasn't the banks that were doing it, it was the investment bankers that were putting all this stuff together. And so it was all structured. So we increased the availability for credit for home purchases due to the political pressures. And if the real banks, underwriters were to look at these deals, they would never have approved them. And if you couldn't qualify in personal income and credit, no problem. We'll give you 100% financing on these deals. Crazy. We'll use pro forma income. We'll structure the approvals. We'll do a 228, 327 loan, fixed for 2 years, fixed for 3 years, and then adjustable rate for the remaining term. So because and the people that were buying this stuff, whether it was Iceland or Spain or whoever, U.S. real estate never goes down. This is a safe investment, says the investment bankers to the people that were buying this stuff. So then all of a sudden, boom. And then the mortgage-backed securities, the rating agents, all these people were in collusion to a certain extent with everybody. Lehman Brothers, Bear Stearns, Countrywide. And then Fannie Mae and Freddie Mac went into agency receivership, so the whole thing was kind of put on hold. They were still lending, but they were not owned. That was a private public partnership, Fannie Mae and Freddie Mac, and then it just became a public partnership. The private piece, which they were New York Stock Exchange held companies, that went away. And then we had 388 imploded lenders during that period of time. In 388, and you can look this up, there's a website called ml-implode.com, and I would look at it in 2007, 2008, and there would be a new lender, bank, done every week. And so take a look at that. And then we re-regulated the industries back in 2009 with the Dodd-Frank, the too big to fail stuff, the CFPB, which is the Consumer Finance Protection Bureau. That's making sure that your voice is heard in case you have to file a complaint against a credit card or home mortgage or anybody. So they re-regulated the banks, and they came back and said, all this 100% financing, not going to work anymore. You need to qualify for these mortgages, and that's what's gone on from that period of time. So this is kind of something that I thought was interesting. These are short-term rates of what it's been since the 1960s to, say, 2023, where we're at right now. So everybody says this is unprecedented. I mean, it's not unprecedented. when I started in the banking, Paul Volcker raised interest rates 5% in one day. We've had 5.25% raised over a period of 12 months. So it's not really that big. And then also too, I always said back at this period of time that this is free money. Really, when you're borrowing money from me at 4% or 5%, that's free money, because the average has been right around 8% over the period of, say, 45 to 50 years. Okay, so it's kind of free money. Okay, so again, yesterday when we talk about apartment ownership groups, who bought apartments? Okay, I know as a group we buy apartments, but I want to talk a little bit about who bought apartments prior to you. Who were the buyers of this stuff? And prior to 2000, who bought apartment buildings? It was three rich guys. Right here, my three rich guys, his wife, the guy who has all the money, and the operator. That was it. 90% of the transactions that we did were the three rich guys and gals. That was how it was done. And then 10% was the syndication model. It was not that. It was not syndication was the rule. It was three rich guys and gals that bought apartment buildings here in Texas. Okay? And so where do they, there was no education, there was no mentors, nobody was telling you, the three rich guys that they were happy with what they did, they weren't telling anybody else how to do it. And then it was the advent of the education mentoring groups that came across. And so where in Dallas were people buying properties? Well, in the 50s and 60s, and these are the age of the properties, it was in the central business district of Dallas. So it was so take a center and then to a scope around it by about a mile or two or three. That's where the buildings were, like in East Dallas, Old East Dallas, out to say White Rock Lake, and then south down to all the way south past Oak Cliff in DeSoto. But when people built these properties, they were 50 units and below, because it was the home builders that were building apartment buildings. They weren't merchant or fee builders. They were home builders that had bought or built a couple of homes, and now all of a sudden that they were going to build apartment buildings. And in the 60s and 70s, we had two-pipe chillers and we had flat roofs. We had all kinds of some of these buildings. They started to phase out a little bit and go out to the near suburbs around Dallas, and the unit count became 75 to 150 units, and they became from home builders to actually finding a niche that they were going to build nothing but apartments. Okay? The 70s to 1986, they went further out, so they went to Garland, they went out to, they didn't go out to Rockwall because Rockwall wasn't there, Heath wasn't there. DeSoto was there, Candlelight Apartments in DeSoto was there. A lot of these, Mesquite, Garland, Wiley wasn't there, Richardson was there to a certain extent in the 70s and 80s. They just kept on expanding out, farther, like the population growth. And they started to go bigger with units. Then it comes a little bit of economies of scale. And then from 87 to 92, there was no building going on. They were destroying buildings like I just showed that. They were destroying the apartment buildings. They were not financing new apartment buildings. They were not building new apartment buildings. There was a donor hole. Nothing was being done from 87 to 92 here in Texas. Okay? And then all of a sudden from 93, the light switch turns on and we're back to building apartment buildings because we're getting everybody moving from Texas, from wherever you guys came from, wherever I came from. Everybody's moving to Texas, so they have to start building more apartments. And one thing I've learned over the period of time, Dallas, Texas loves to build apartment buildings. Loves it. They can't do enough of it. And so who were the tenants prior to the 2000 for a landlord to buy? They wanted to buy into workforce housing. They weren't buying the A-class properties, they were buying C-class properties, and they were looking for, and I'll handle that, they were looking for a stabilized property. They were looking for immediate cash flow. They were not looking to do a rehab on a property. They wanted a cash flow of the deal right from the beginning. Okay? And so how were they financed? Through Fannie Mae, Freddie Mac Bank. There was a little bit of subprime, but not by very much, and no FHA. They didn't do a lot of FHA. And how long they'd own these deals? From 5 to 10 years. Okay? All of a sudden, that changed. Now, post 2010. Again, I'm trying to bring you up to speed in my world. Okay, does this help you? Does this make sense a little bit? Okay, 2010. Who bought apartment buildings? It was a syndication. The rich guys were out. They because these properties were starting to go up in value so much that it was only the syndication model that was able to buy these apartment buildings. So the three rich guys and gals, they got into it a little bit, but they were starting to sell out to the syndication models at that period of time. So, and then everybody who, there should be a V, who previously closed one deal was an educator / mentor, okay? So they didn't know very much, but they were more than happy to share that with you. Okay? And then who came into the business? It was engineers, professionals. Your brother-in-law came in, doctors. They had a little bit of knowledge. You know, they all came into this stuff. And where in Dallas did people buy? Everywhere, especially in areas of B and C, because they wanted to update with that $5,000 per unit in rehab dollars on the properties, and they were more interested in doing a value add. They didn't want the cash flow. They wanted the value add to try to get a capital gain on the deal. Some like some workforce housing today, some workforce housing back then, some workforce housing today, but we're looking for higher quality assets with a better credit quality tenant. Okay? And how they were financed, this is all kind of wacky because it's been brought together. So in 2010, it was Fannie Mae and Freddie Mac with some subprime, but in 2019 to today, a lot of, till like 6 months ago, it's been non-recourse bridge, adjustable rates, interest rate caps, and the 3-1-1 structure. That's 3 years, 1 year, and another year. So that's a short maturity, okay? How long would they own it with this structure? 3 years max, and they needed that 22% IRR. Okay, that's what everybody was asking for. I'll invest if you can give me that 22% IRR. And I'll talk about that in 1 second, because that's important where this story is going. So, but because they didn't understand the risk to try to get this 22% IRR. What's going on today? Okay, there's a lot of things going on today. Our transactional volume is down 80 to 85% within 12 months. Okay, interest rates go up, brakes come on. That's what we're seeing. We're just seeing. Rental growth is slow, but still positive in most markets. We're still positive in most markets. Fannie Mae fixed rate is kind of the lender of choice. Rates right now are between 4.75% to 5.25% on stabilized properties. Average term is 7 years fixed with the yield maintenance, with the step down prepayment penalty. Some of the stuff I'm throwing out there, it's a different language, and I'll have to tell you what it means after we're done here. But we need more money for the down payment, and the average equity needed for these transactions is between 35 and 40%. Significantly much larger money that has to go into these transactions. The 125 debt coverage ratio is not going to change. We're going to have that. Fannie Mae, Freddie Mac has to make sure that you're making a profit for me to give you a loan, that you have enough income to pay for the mortgage payment. We don't want to do a negative. We got you right from the beginning. You got to have positive cash flow right from the beginning with Fannie Mae and Freddie Mac. They're not a bridge lender. They are a stabilized lender. We're doing more Fannie and Freddie assumptions. They're being done more frequently. And bridge arms and fixed are still available, so we can still do bridge loans, and we can probably go up to 65 or 70% on these deals. But I mean, look at these. I mean, the arms are. This is a 5% SOFR, which is like the index, plus 4.5, so that's 9.5% rate, versus a fixed rate of 9.75. So these are bridge loans. These are not Fannie Mae and Freddie Mac loans. Fannie Mae and Freddie Mac loans are 4.75 to 5.25%. So that because these are based on the 10-year Treasury, and these are based on the short-term rates. Okay. So regional banks are not lending, or if they're lending, it's a much lower leverage, and there's no construction money for new apartments, which is good for us because we compete against new apartments. And so if you're not going to have a lot of inventory out there, that's going to help us to buy, say, the Mark right now, because you're not going to have a lot of competition for another 3 years. Nothing's going to happen for another 3 years. It's tough to make deals work at prime rate, which is 8.25%. 8.25% prime rate these days. Raising money is more challenging, except for good transactions. So people who have a good transaction, there's plenty of money that comes in. Transactions that are marginal are not getting to get funded. Values are down, cap rates are up, okay? So we're about 15 to 20% in most markets throughout the United States down. In some places we're 25 or 10 to 25%, somewhere in there. But we are down in values. Institutional buyers are not buying, like Blackstone and some of these institutional groups, they're not buying with debt. They will buy with cash and hope when interest rates come down that they can refinance. So our phrase really is date the rate, marry the deal. So if it's a good deal, buy the transaction. Get into it, but only date the rate, and it could be for a short period of time. So there's a lot of bridge loans that are coming to a maturity, and it's going to be over $1 trillion. Because these bridge loans, like we talked about before, were like the 311s. Those were taken out in 2019. There's a maturity that's coming, and it's gonna be like a tsunami. So it's not just multifamily. Multifamilies is in the best position because we have the agencies to back us up. Office buildings, retail, everything else that does not have Fannie Mae and Freddie Mac attached to it, that's going to be a problem. Regional banks are not lending. CMBS loans are not out there. Commercial mortgage-backed security loans are not out there. We're going to come to a lot of these maturities, and people are going to have to make decisions on the lending side whether they're going to foreclose upon the property or just kick the can down for another year or two or three, waiting for interest rates to come back and for the lenders to come back too. Okay? So we think that if there is a maturities, that could be a great opportunity to buy properties from people that maybe didn't put enough money aside as liquidity for a rainy day. Today's a rainy day. If I had an umbrella, we'd have it out right now. And that's the opportunities that we see for investors that come in the future that they're going to be able to take advantage of. So investors fail to understand risk versus return. Is a 22% IRR the same on every structure? They're not. They're not. So everybody thinks that the 22%, again, I make that up. It could be 20%, it could be 14%, but some people say maybe it's 50% or whatever. There is different ways of structuring these transactions. There's the lowest risk, and then there's the highest risk of these deals. And so what happens with the highest risk type of stuff? Anybody know who this guy is?
Yeah.
Who's that?
I think he's a Gajarelli.
Jay Gavinelli, right, Appleway Investments. We did not do the loans on those properties, by the way. So Jay Gavinelli, he took the highest risk. He did a loan, he did a bridge loan. So again, we talked about risk. Bridge loans, Fannie Mae fixed rates for as long as possible versus having the property paid off. If you take a little bit of risk, Fannie Mae is probably the way you want to do it, or even Freddie Mac. He did a bridge loan, a 3-year loan, interest only, but he thought the interest rates weren't not going to go up. So he didn't do an insurance policy called interest rate cap. Okay, so he didn't step in to pay for an interest rate cap on that deal, where he could have paid something, okay? And then he had preferred equity that he was paying a preferred person that invested in his deal, like say 15%, okay? So he probably paid them 9% current, and they accrued 7 or 8% on the accrual piece. So he had to pay 9% every month with his payments going up because he had no insurance on the deal. His taxes rose, his insurance rose on the deal, and it became a cluster. And then he eventually gave the property back. The investors only had it for 1 year. Had it since April of 2022. By April of 2023, $78 million in equity went poof, okay? He promised everybody a 22% rate of return, but nobody understood the risk that was involved in the deal on the debt side. That's where I'm trying to tell you today, there's stories about understand the risk that's on these deals too, okay? And so why I think this is interesting, so this guy, this is Jay Gavinelli, this guy is the head of Arbor. Arbor made the loan on the bridge loan on that deal. Again, Arbor lost $32 million. All of his investors lost $78 million on that deal. Again, this was like 3 weeks ago, by the way, down in Houston. So over a period of time, he thought it would probably be a good idea to try to get my leases out for a year. So he signed up a year leases on the deal. And then he said, I probably can make more money if I do like a VRBO or Airbnb in some of these units. So he hit a bunch of units that were vacant, and so he put some people into Airbnb units. So he went from renting it out on 12 months to renting it out on 4 or 5 or 6 days. And then what happened was the city of Houston said, we don't like your new idea. And you're supposed to say, what was his new idea? Well, he went from monthly or for a year to weekly, and then all of a sudden he had this sign in front of his property. And this is a real sign in front of that property. And if you can't see, it says solicitation of prostitution is a felony. So he went to hourly. He rented out those rooms on an hourly basis. So the city of Harris County said, you can't do that, come on. So that's the importance of working with somebody like Darwin who's in the middle of things and knows exactly what's going on with all these properties. Knows exactly what type of debt we have and has exactly what the equity is into these deals. And he's 100% transparent. All right, today, let's talk about tomorrow. Okay, what do I believe? People ask, what do I believe? Okay. Dollar cost averaging into a property. Similar to like stocks, properties were high, properties are going to be low, dollar cost on the way down. I don't know when the bottom is going to be, and I certainly don't know where the top is, but if you're going to buy something, buy it on the way down, it gets a lot cheaper. Invest with good operators. Not the ones at their first rodeo, so to speak. You want to have somebody that's been around. In Darwin's case, he's been doing it for almost 34 years or so. And again, I'm just picking on Darwin, but look for good operators. That's very important. Have more than enough liquidity for a rainy day like we're going on right now. A lot of the people that are going to have problems with these maturities never counted on a rainy day. Take the shorter term fixed rates today. Don't take adjustable rates, don't take bridge loans. Take the shorter term fixed rates for 5, 7, or 10 years, in my thing. Continue to maintain the asset. That's the worst thing you can do is pay your investors and not pay and maintain the asset. That just continues to spiral down. So if you have other general partners that are not paying distributions, that's okay. Save the nest egg. Don't pay distributions during this period of time. I'm good with that. Buying in good areas. What's Michael Becker's rule number 1? Thank you. No buy in the hood. Thank you, Reinhard. Appreciate that. Don't buy in the hood. Demand GPs overly communicate. Find out what's going on. Some GPs put their head in the sand. We don't like those people. They don't tell us what's going on. You got my money. What's going on? If you don't tell me, you're stealing my money. At least that's what my perception is when I go to bed at night. You have my money. So you got to tell them what's going on. Just have open dialogue about what's happening. Take the long-term approach to investing. Don't take the short-term approach. And what?
Take the shorter term fixed rate. Why do you recommend taking the short term fixed rate?
Because right now we think interest rates are high on the fixed rates currently. And so if we think that interest rates are going to come down.
Repeat the question because they can't hear it online.
So the question is that why do you make the assumption to people to take a short-term fixed rate? And so my suggestion is right now, we think interest rates are artificially high. Okay? We think in a period of time that they're going to come down. Okay? But find some way to get out of this loan in the future that's not so, it doesn't cost you much. Commercial loans have some sort of a prepayment penalty on them. It's different from home loans. So when you sell your house, there used to be prepayment penalties back 35 years ago. Today, there's no prepayment penalties on your house. The Congress did away with the prepayment penalties. So, but on commercial loans, we have prepayment penalties. They can come in the form of a step-down prepayment penalty or a yield maintenance, which is kind of a prepayment penalty based on where the interest rates are. We have a thing called defeasance. So again, what do you like? Chocolate? Do you like vanilla? Do you like strawberry? You get to choose at the beginning of what type of loan you want to have that has these different types of prepayment penalties. So my feeling is that we think interest rates are going to come down. Now, if interest rates come down and you want to try to get out of this loan within the next 2 or 3, 4 years, we want to have that exit fee as low as possible. Make sense? All right, let's keep going. Good question. Thank you. All right, again, take the long-term perspective. Okay, and here's I'm going to wrap this up in a second here. Commit to what you believe in. And I certainly commit to what I believe in is remain committed to buying multifamily properties. I commit to buying commercial real estate over a period of time. And I've done this for a long time. And by the way, I'm rich. And I don't mean to brag, but I've been doing this longer than anybody has. Okay? And I've seen the opportunities to buy. Believe in the American economy, remain invested. These are some of the dates where you may be familiar with. October 29, December 1941, October of 87, September 2001, and March of 2020 with the pandemic. So these are all times and the months that was a challenge to the United States. It shook America, but it did not shake the American confidence. So our thinking is bet on America. Take the long-term perspective. We're not buying alternative assets. We're buying alternative assets, but we're buying hard assets, not paper assets. And if you invest in the short term, like that gentleman we just talked about before that liked to rent his units out on an hourly basis.
Carry that for fun.
It says invest short term, it could be challenging. And we admit to that. It could be challenging. So interest rates will go up, they could go down, values will go up, rents and NOI will go up and down. So different political parties will come and go. We just know that. That's the way it's going to be. But one of the things that I remember in real estate is you get rich when you have a long-term horizon. And that's what we're talking about here is long-term horizons. So this is a property that I did a loan on. How many people are from Fort Worth or know Fort Worth very well? Thank you. So this is a property called Crest Ridge Apartments over off of White Settlement. Next, you know where the cemetery is off of White Settlement and University? Green Hill. Right there. So go down to the west. This is on the right-hand side. It looks like this. I mean, tall trees. The property was built it was on the drawing board in 1937. It was completed in 1938. When it was built in 1938, it was a Class A apartment building in Fort Worth. Okay? I did loan the property. I was walking through the property, and they had like a time capsule box on the wall. And the time capsule box was the plans of this property. They were blueprints. It was in a box on the wall. And what's the shadow box? Is that what they call that? And they also had what the rents were in 1938 when this Class A apartment building was built. Any idea what rents were in 1938 on a Class A building down the street from your parents? $27. $27. And so when I did this loan,
What was that, 27 a month?
$27 a month. $27 a month on this beautiful property. Okay, this was a high-end property. You know where this property's at. It's right across the street of the beautiful streets of Hamilton, and this is a nice Monticello. That's exactly where it's at. Nice area, beautiful property. Any idea what rents are today? I don't know what they are today, but I can tell you when I did this loan, they were $1,975. That's $1,975 a month on this property. Okay? My thoughts are, over a period of time, you will do great in commercial real estate. Get in, get an opportunity, stay the course, stay committed. Okay? That's all I'm going to say today. Was there any questions before I have to wake you up? All right. Any questions? Yep.
I'm curious, that arbor, how come they did not, I'm just curious, that arbor, they did not require the borrower for the insurance on the cap rate?
So if over a period of time, Arbor did not require it. Arbor did not require it. And the borrower was given the choice. Arbor, the lender, who put the whole transaction together, and they did 4 loans on this property. And they gave this person a chance on 4 times that they did not require him, but he didn't think enough that interest rates were going to go up. So, when interest rates, when your mind thinks that interest rates for the next 6 months, 6 years, are going to remain at 3.5% like they were when they originally, maybe it was at 4% when he originally took off, and then it went to 9%. That's a shock when you owe $232 million. Isn't that crazy? Crazy? Yeah. Lynn.
Quick question. Can you give us some kind of idea as to how much interest it is to go up in relation with and how much the cap rate is going to go up? Just repeat the question. Is there some kind of relation?
So the question really is concerning if interest rates go up, what's the cost of the interest rate cap? What's the cost of the insurance? So there.
Interest rate cap rate. What cap rate?
So the interest rate cap rate is insurance. Okay? It is.
No, not that. If interest rate goes up, cap rate goes up with it, right? And the property value goes down. So in what proportion
are you talking about not the interest rate cap, but the cap?
Cap rate.
Okay. So the cap rate on a property, what does that equal out to? I have no idea. No, I can't tell you what that means in terms of a percentage. If cap rates go up, like we use revision cap rates, so we buy a property at 5%, and over a period of 3 years, now it's at 5.5%.
Because we went from interest rate from 3% to 5.25 now, and cap rate has gone up by only so much. Is there some kind of relation between?
I don't have that.
There is no formula.
There's not a formula because sometimes it just comes into the supply and demand of other properties in the marketplace itself. We think caps are related to that, but it's not always the case where interest rates go up and cap rates go up at the same time.
Nothing, I'm bringing this so we can hear what Anand says. He's got a question.
So just alluding to the fact, you mentioned about office and retail, they're hurting significantly. Office with people working from home, retail with a bunch of anchors closing down every single week.
Yep.
So where or how is it going to trickle down into the multifamily and rest of, commercial real estate?
So the question really is that what's our belief where multifamily is going to be maybe a year from now or 2 years from now? I mean, I just take a look at San Francisco. San Francisco had 7 or 8% vacancy about this time last year, a year and a half ago. Today, 1 out of every 3 buildings downtown, office buildings, are vacant. So, maybe that's the politics and the progressiveness of San Francisco about what's going on there, that people don't want to work there. But San Francisco, or office or retail, they don't have a backup plan to figure out what the financing is going to be in the future. So I think that's going to have a problem. But again, there's 2 things that banks don't want to own the real estate. We just want to rent you the money. You operate the real estate and kind of figure that out. And, if you see that if we take these properties back to the RTC and the OTS, we're not good at figuring that stuff out, and we have to sell it at pennies on the dollar, and then we have to make you jump through hoops to try to find a qualified buyer to buy a property at $17,000 a door or wherever the hell you were selling it for at that period of time. But my feeling is that I think office and retail are going to get more challenging, but I don't think Fannie Mae or Freddie Mac is going to be challenged that much. Money, liquidity solves a lot of problems. So we're going to do the Old Capital speaker series, which comes on this the 17th of May, we're going to have somebody talk a little bit about capital calls, because that's one of the things that we're challenged with. There's a lot of people that have to put money back into these deals to keep them going, because our phrase, as you know, is survive to 25. We want you to keep in the game, keep the property, don't give the property back, survive until 25, but you may need to come in and have somebody reach in their pocket and give $15,000 or $20,000 more into the deal. So we're going to tell people, give demonstrations about how to ask for more money to keep this thing going.
Okay, can I throw in a couple of things on that same thing?
Go ahead.
First, office and retail, yes, they are struggling. Why we love apartments is everybody always needs a place to live. So there's always that. And with interest rates being higher and loan dollars being lower, most people can't buy a house right now. Prices went way up, they don't have the down payment, the interest rate they can't afford, so they're being pushed more into apartments and rentals. So overall, that does real good. And to give you an idea, we did some stats, and our portfolio wide rents year over year are still 7.5% up year over year. And values though, I use 1019. We analyzed 1019 down in Fredericksburg because there's some new competition coming in there, so we're contemplating selling that asset. We have a BOV of $20 million, meaning the broker thinks they can get $20 million. We paid 12. Our exit that we projected was 16.5. If we were to sell it January of last year, we might have been able to get 24 million for it, okay? And now it's 20 million. However, with our underwriting, we had underwritten it, selling it at 16.5. So because we are conservative on our underwriting, that puts us in a big position. So we're not, all the risks that he's talking about, we mitigate that where we take a lot of reserves. So we've got a lot of money in reserves. We haven't been doing distributions on the properties we recently bought. We're making sure that, and that's a big question is, when are we going to do distributions? Well, you just heard the Godfather here say, hey, you know what, survive to 25, don't do distributions, protect the asset. And that part of our motto is investors first. So we want to protect the investors. Protecting the investors means protecting the asset. Protecting the asset means taking care of our residents. Taking care of our residents means we're taking care of our staff. So all of that goes to riding through this wave. I did a quick graph real quick just to show you. Okay, a cheesy ass graph. But value was going up. 2021, rents went up 20%. 20%. Okay, so that had the values go way up. Well, now what goes up must come down. Okay, so interest rates go up, cap rates go up, values come back down. But it's still on that same trajectory as far as going up over time. I said it's like a yo-yo on an escalator going up and down. However, our cash flow, here's the cash flow. It went up, well, it went down a little bit. So it's nowhere near as dramatic. That's why you hold it long-term with long-term financing so you don't get caught with a bridge or anything like that, where you can ride through the storms. We've talked about that as far as that's why we set it up the way that we did. More questions? For the Godfather.
My question for Paul and Darwin are, with these notes coming due over the next 2 years for the multifamily projects that are not structured well, not financed well, whatever, do y'all have your crystal ball tell you when you think some of these units are going to be available where you can buy them for just a little bit more than the debt on them at the time?
Some are coming due right now. So, there's a 8 property portfolio that's going to come onto the market right now. So it's coming. So it could be October, November, December where the first wave is. But if you saw the chart that I see every day, I mean, it goes up. It goes up rapidly about the amount of maturities that are coming due right now, and the lack of liquidity of these a lot of these groups. They don't have money. So and then it becomes back to the lender, the CLO, the collateralized loan obligation on the deal, who actually holds the paper. So we may think it's Arbor that holds it, but it could be it's somebody else that holds the deal. So it's up to them to make a decision where do they want to foreclose upon the property like this? They knew that this guy was a bad operator. They had so much money involved in that deal that they did not want to see that thing degrade even farther down. So they pulled it. But some of these deals, we don't know if they're just going to do a forbearance agreement, which means that they're going to kick the can down the road and make payments on the backside whenever the market approves. One of the things I learned in 2007, 2008 with all these lenders that took over all these properties, that if you only waited for another 18 and 24 months, instead of taking back the property today, if they had done a forbearance agreement and just kept the deal going, that they would have been fine. The lender would have been fine. They wouldn't have had to mark to the market and take a loss on the deal. So I don't know how many people are going to mark to the market and take a loss on these deals, but I can tell you it's going up high. I mean, the maturities are going to come to the market real high.
Are the examiners going to allow the lenders to kick the can down the road?
So there's different types of lenders. So the bank lenders are they are having some problems because that's some of the things that the regulators are looking at to kind of figure out what's our exposure on these deals. But like this deal that I showed you with Jay Gavinelli, that's an unregulated business. So that has no regulators on that type of a deal. So in the trillions that we talked about, a lot are unregulated. So the examiners are not going to take a look at that type of stuff.
And the big wave, like you were talking about, is those bridge loans that are 3 + 1 + 1. So a maximum of 5 years is when those are,
Yeah, but remember on those 2 additional 1-year periods, those are fully amortized. Those are not interest only. And all these deals have debt yield covenants, which means that you have to be in a typical transaction where it's a bridge loan, where it's a value-added property. You walk in and you're buying a $20 million property, but you think after you spend $2 million worth of CapEx that the property is going to be worth, say, $30 million in 3 years from now. You put the money in, you're able to get higher rents, better NOI, you're able to refinance. Well, right now, we're flat in terms of rental growth. We're up, but we're pretty flat. The debt yield is supposed to look like this. It's supposed to go down during the period of times that you're rehabbing the property, but after you rehab the property and turn the switches on, that you re-tenant the property with higher rents, it's supposed to go up like this. Well, with flat numbers like there, you're not going to hit your debt yields, and so you're not going to have the opportunity to go to years 4 and years 5. So that's a problem. And so that's going to be up to the lender to make a decision whether do you have to put more money into these deals, so they have to call for capital calls. For us to do that, if you're a lender, we'll give you an extension of time, but you're going to have to raise more liquidity and have it available, and buy another interest rate cap.
So
Which
Paul,
can be expensive.
Let me jump in here.
Which is a lot of money.
So you guys have heard that real estate is a team sport, right? Paul, we've known each other for years. Paul's up here, and what I want you to understand is he is not only a guest speaker as an authority in this business, he's a partner with us. This man has placed, well, I would say easily 80% of the debt of the assets that we own.
With you guys, and 1 out of every 3 of everybody else in Dallas and Fort Worth.
Yeah. So the reason I want to ask you a couple of questions is this. So you have a vested interest in our success, but you also come from a completely separate and apart perspective globally as a lender. A couple of things that just struck me were, one, you talked about cash calls, and cash calls are coming. Believe me, they're coming. There's no ifs, ands, or buts. Our cash calls are small. Our cash calls are no distributions on some properties, and I'm glad you brought that up because cash calls The way I look at it is, and I get these calls all the time. Calls, I mean literal calls. I get calls, hey, Julian, when is XYZ property going to start distributions? And my answer is, well, one, we're still in the middle of a rehab, but more importantly is, if we start distributing and I give you $150 distribution, is that going to change your life? Or would you prefer for us to keep it in reserve to protect the asset, as you said, if they had waited how long? Say 18 months?
18 months.
18 months, and we're 12, 18 months down the road, and now we're out of it. You know, it's like this, when you, a couple of days ago, the skies were just opened up and it was pouring rain, and then in no time at all, the sun was shining.
It
So
was.
that's gonna happen. So my point to you is, listen to this man from two points of view. One, he is our partner, and two, from an industry expert, that cash or distributions are inconsequential when it comes to protecting your $100, $150, $200, $300,000 investment. Okay, so I say that not in a self-serving way, but as a responsible individual that is protecting your capital. So let's be mindful of a couple of things. One, that's what we have to do to protect the asset. Two, that we rely on experts like Paul to guide us through in Darwin. I'm not marginalizing Darwin, even though he's sitting over there. That you have the kind of transparency and the kind of responsibility that we owe you, this fiduciary responsibility to protect your investment with us. So therefore, right now we have questions all the time as to where's this market going. We don't know where the market's going. What we do know is that history does repeat itself, and if we manage the cash flow, we manage the way that we do things, that sun will come out. One other thing you were talking about is the bridge debt bubble that's coming. We don't have any exposure, and I say this proudly, zero exposure to variable debt. All of our debt is fixed, period, the end. And that is what we call protecting you as an investor. That is not self-serving, that is professional management, asset management. And
Well, I'll tell you this. I'm like you. I got a lot of money tied up in Darwin. So I want to make sure this stuff works. And so I'm making sure that you're protected on these deals.
yeah, so we thank you for coming. We
No
thank you
problem.
for who you are, our partner. So for those of you who are new or first time here, stick around, chat with us. We'd love to get to know you, and more importantly, get to know some of the people who have invested with us over the years. Quickly, how many people that are left in the room, and I know we ran a little late, have been with us for 2, 3 investments, or say 3 or 4 or 5 years? All right. So for those of you who are new, talk to those people. Don't listen to me. I have a vested interest. Listen to what they have to say, and then you get a better perspective. Thank you for coming, everybody. Good night.